Well, happy Friday. How are we doing today? It's Good Friday. So hopefully you got some great plans for Easter this weekend and happy Easter to you. So jobs report came out today and we were expecting that to be kind of a miss because what happens is the, um, the job report, there's a precursor that comes out on Wednesday of the first week of the month. And so that number was off. So we were thinking, okay, the actual jobs report comes out the first Friday of the month today. And so subsequently, we were expecting that to be off. Well, it wasn't. It was actually pretty darn close. So, today is also Good Friday. Because it's Good Friday, there's just more of a kind of a skeleton type crew as far as traders on Wall Street, and the market will close early today because of the holiday. So, because of that, because you have so fewer players, then any one player can make that market be volatile. So volatility is very common on short trading days like this. So I'm going to sit down, or I'm going to do this video with Barry Habib and his son Dan, and kind of break down this jobs report, which would be good information for you to know. Again, just great talking points from when you're talking to your customers and clients, as well as just good information for you to know. So let's just kind of go from here.
Let's break this down together. So I'm going to bring up the chart here to show where we are. So jobs number 236,000, pretty much a dead hit on estimates. But the revisions for the past 2 months, slightly lower, so not much there. But Dan, break down the household survey for us.
So remember, team, there's two surveys within the jobs report. You have the business survey where you get that headline job creation number, and the household survey where you get the unemployment rate from. That household survey has its own job creation component, and it showed 577,000 jobs created. Can be a very volatile survey. And if you take a look at the labor force, it increased by 480,000. So because you saw more job gains in that survey than the labor force increase, the unemployment rate did decline slightly from 3.6 to 3.5%.
And Dan, that's for the right reasons, wouldn't you say?
It is. This is not a scenario where you see, really weak job gains, but the unemployment rate declines because a ton of people left the labor force. This is actually, for the correct reasons, as you stated.
Yeah, and the participation rate also did increase. Now, we talked about this. Average hourly earnings were up 0.3% month over month and just 4.2% year over year. That's a drop from last ones, and it's the lowest post-COVID increase that we have seen. So wage pressure inflation is coming down, and this is what we talked about here. The average weekly hours, 34.4 weekly hours from 34.5. Now, that might not seem like it's a lot, but it is the lowest since September of 2019 if you exclude the COVID period. And Dan, you broke this down with the numbers.
Yeah.
So talk about how that equates to 468,000 job losses.
Well, because you have to factor this in that this is the average amount of hours for the entire working force out there. So you have about 161 million people whose hours were cut by 1/10 of an hour on average. So if you extrapolate that, that would be not dissimilar from seeing 468,000 job losses. Now, it appears, as you stated in the bump here, that maybe instead of reducing headcount, you're seeing hours being cut to save on costs.
And Dan, it's a natural progression, isn't it? I mean, we're seeing the JOLTS numbers. So the job postings come down, and you kind of see hours worked come down, hirings will begin to slow, and then eventually you'll start to see the numbers reflected in initial claims. That'll be the last one. That's the most lagging indicator. So weekly earnings was flat. That's another thing to think about. That's dominated by the fact that the hours worked declined as well. And this is the lowest number in almost 2 years, since May of 2021. So it's been a while since we've seen this lack of pressure in wages. And that's a good thing for inflation. Maybe the bond market, if it was fully open today, this would be something that would be a spark. And Dan, where the jobs came from, I thought was interesting as well, because as we've been talking about, leisure and hospitality, right?
Yeah, this is the sector which has been the biggest kind of engine of job growth. And we've been talking about how it doesn't seem like there's that much more of jobs to squeeze out of that sector because we're getting back to all the jobs that we lost pre-COVID or after COVID. So leisure hospitality, though, in this report, it still added 72,000 additional jobs, but now that has retraced and gained back 98% of the jobs that were lost. So you'd have to expect that going from here, there's not much more left in the way of job growth in this sector.
Yeah, we're 378,000 jobs below the absolute peak before COVID hit. And then, government added 47,000 jobs. So maybe, Dan, not as strong a jobs report as the numbers would lead you to believe, but not a bad report either. Truly a mixed bag.
I would.
So that's what's going on with that. So I want to show you, take a minute, and I'm just going to change this. This is the current market live as of 10:30 this morning. So the mortgage-backed security market is right here, and it's currently down 48 basis points. 100 basis points is 1%. The graph, if you look at the graph, this is the last 90 days. Each one of these, they're called the candlestick, represents a day. So you can see that's April 4th, that one is May 30th, and so on. So basically the way to read this is green is good, and if it's green, you read the top, and if it's red, you read the bottom of the candlestick. So you can see that we dropped all the way down here, and we're right here. And basically that is a point of resistance in the market. You've got actually double piece of resistance right here because you've got the 200-day moving average, and then also this Fibonacci level right here. So don't get caught up in those terms, but understand their points of resistance. So hopefully that should hold. We believe, and the bummer is when this goes down like this, that means rates have gone up today. So we've had a good little run of rates trying to get better, and then yesterday and then today rates are not doing so well. But again, we've got a short trading day, again, volatility. We think that this jobs report wasn't bad. I mean, it basically came in at where it should have been and what they were expecting. So we think that probably first of the week that we're probably going to get some bounce back off of this. Next week's going to be a pretty big week. Quite a few things going on. There's a 10-year Treasury auction, a 30-year Treasury auction. CP Consumer Price Index is coming out next week. So a lot of information coming out. And so I just want to keep you in the know, let you know what's happening, because all of these things affect interest rates, and interest rates affect our livelihoods. So anyways, hope you have a great weekend. Happy Easter to you. And if I can help in any way, please give me a call, 541-735-9857. Have a great weekend.